If we trade into a higher time frame key level and reject from that key level, you have my model. Now, I wait for this every week inside of my Discord, and it's pretty much the only model I trade. Part of me can't believe I'm giving this information away for free, but it's a very simple, pretty mechanical model that you can use as well to get funded with different prop firms and finally make some money from trading. Now, it is not simple. I'm not saying it is easy, but it will help you finally get funded with these prop firms. Let's not waste any time and dive straight into this video. So what is the model defined by? It is defined by a premium and discount, a key level being hit, meaning the key level has to be in a premium and discount, and then displacement. Then we form the model in a market maker model. So we fractalize the model of a reversal into a market maker model. So the model is based off of reversals. Now, not reversal in what you're thinking a reversal is. Any turning point in the marketplace is technically a reversal. Every swing point in the marketplace is a reversal. Let's dive straight into what the model actually looks like. So you can see here we're on USD JPY, and this is a trade I called out yesterday to my private Discord. I traded this day and we caught New York sells down to this imbalance here. So what does the model actually look like? Basically, it looks like this, okay? A swing point, a reversal. Now, you can see what we have. We have a dealing range high and a dealing range low. This is the dealing range high because this created the momentum move down. We have to be in a premium for this to actually show my model. So we wait, when we're down here, we are waiting for us to get into a premium. Why? Because order flow is bearish. We still have these lows intact down here. So we're not in the business of picking bottoms in bearish markets. We're not in that business. We follow order flow until proven otherwise. With that in mind, when we come back into a premium here and hit a key level, the key level being this order block here, because this is the lowest close on compared to this, and then the wick here that traded down, up, and then down again. This area is a key level. Okay, so you're using that shaded area there, and then we form a reversal at that point. Now we went expansion, consolidation, retracement, and then reversal. That's where the best model forms. So removing this orange shaded area, just keep it in mind. What happens then? Well, then we take out a high. Okay, so liquidity, remember I talked about dealing ranges in my last video. If you have not watched that, go back to the video and watch it, because that is where I explain external range liquidity. Now, with that being said, if you are new to the channel, please do subscribe and drop a like. It doesn't cost anything, but it helps boost the channel and helps me reach more people to actually help with these concepts, because we're in a hard business. Okay, we're in a very hard business, and I like to help as many people as possible. So enough of that. Anyway, the displacement here, when we take out this high and then below the low, that tells us that price is willing to go lower. So at this point down here, as soon as we displace with that momentum and break the low there, price is willing to go lower. Why? Because we also disrespected this gap. Now, if we are bullish, you'd ideally want this gap to hold, right? But notice how it cuts through it. It cuts straight through the gap. This confirms the model to me. So in your notes, right, what confirms the model is a key PD array getting violated and then used on the other side for distribution. Meaning, once we trade below it, we want to see it used for selling on the other side, and vice versa if this is a bullish example of my model. Now, on the daily chart, it will look something similar to this, because every reversal looks something similar to this. Now, it's not going to look the same every time, but it will look something like candle 2, taking out candle 1's high, and then trades back, closes inside the candle, and then we distribute. Something like this, for example. Close inside, distribute, 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 right? So it may look different at times, like here we take out the high, close, and then distribute. It looks different from time to time, but overall the model is the same. Now, when we actually displace through the key premium array, at that point the model is confirmed to me. Now, and only now, I can start looking for selling. So what made me be able to start looking for selling? This array getting disrespected, this external liquidity getting engaged, and then the displacement we had here. This is not a lethargic move down. It's not like this, is it? This is strong and really showing that price is in a rush to get somewhere. Get down to where? The original consolidation lows. So if you take this area, this is your original consolidation. This is an area where a lot of resting orders are lying, okay? A lot of people have their stop losses down at that area there. A lot of stop losses are there, and a lot of breakout traders are looking to go short here. Now, I mentioned in my Telegram group recently that a draw on liquidity is like a magnetic table. If you threw a bag of paper clips on a magnetic table, not all of the paper clips would attach themselves to that magnet. Most of them would get there, not all of them would get there though. Those paper clips are like your trades, okay? You do not need to get all the way down to your draw on liquidity to make money. Could you have not made money in the selling here, in the selling here, in the selling here? We, inside my private group, made money in the selling here, from about there down to here. That's where we made money. So did we take out these lows? No, we haven't yet. Now we may still do so, but we haven't as of yet. It doesn't matter though, because we don't need to for us to make money. And that's important you guys understand that with this model. You do not need more than a 1 to 3. Now, after that, all of that logic has formed and we've disrespected our key premium array. After all that has happened, what are we now looking for? Well, we are now looking for key fair value gaps and key stop runs. So take a look at this here. This high gets ran and then this fair value gap holds. This high gets ran and then this fair value gap holds. So when we run out a high, also here as well, that happens again. When we run out a high in a sell model, instantly you are thinking, okay, if we snap lower and create a fair value gap now, I am going short. Because that is what the algorithm is doing. As soon as we run out a high and it snaps lower quick before you can react, that fair value gap that forms is the displacement. That's the algorithm flashing and showing its hand to you. So we take out the high, displace lower. This fair value gap here holds for lower prices. Okay, you can see right there, that does in fact hold for lower prices. Okay, we do it again. We take out this high here, that fair value gap holds for lower prices. And that is all you need for entries. Now, when I teach this model to people, a lot of people want to drop timeframes and become a great trader and try to trade the 1 minute time frame and fractalize this down to the 1 minute. You do not need all that. This is more than enough. You can trade this on the hourly time frame, on the 15-minute time frame. Really, because you're watching this video, I'm assuming you're not profitable yet or you're on the verge of profitability. I wouldn't recommend going below the 15-minute time frame. There's absolutely no need for it. If you're profitable, collect your data on that lower time frame and then work from there. If the data is showing that it's worth you moving down time frame, by all means, be my guest, right? Fractalize this model down to an hourly reversal. But if you're not yet profitable and you haven't got the data to back up drop in timeframes, please just trade the 1 hour or the 15-minute, because 1 hour gap is usually a 15-minute stop run and so on and so forth. There's no need to be dropping timeframes. It's just going to get too much and you're going to overcomplicate it. But overall, this is the model. So recap, what are you looking for? Premium and discount. Always, 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 guys, this must form in a premium and a discount in line with what? Order flow. Now, from January, you can clearly see we've been trading lower. So order flow is bearish. So when we retraced into this premium, what do you think I'm thinking? If this candle takes out the high and closes back inside, I'm thinking reversal straight away. That goes straight to the forefront of my mind and I'm thinking reversal. Now, what am I looking for? That hourly displacement. That's what you want. That is telling you that price is willing to go lower now and any stop runs are just to redistribute orders. To stop early sellers out because they will jam their stop losses down. That's what retail do. They jam their stop loss way too early and then we get a stop run and it goes in their direction. How many times has that happened to you? With this model, I stop that happening. That stops happening because you're waiting for that to happen and then you're engaging with price. And only then are you engaging with price. This model can turn you profitable. Now, the secret behind profitability is the trader themselves, the risk management. the being able to sit on your hands for a week. That's a trader. But this model alone can make you money. Why do I know that? Because it makes me money and it makes my students money. Okay? Every week this appears 1 or 2 times a week. And I mean that. I'm so serious about that. 1 or 2 times a week this appears. This is the money maker. This is pretty much all I trade now. I'm at the level where I've realized less is more for me because the capital is high and the risk is low. Okay? So when I'm waiting for this, that's all I'm thinking. There's no FOMO. There's no increase in heart rate. There's none of that whilst I'm in a trade because I'm trading a very simple model that appears often. Logical framework behind it using liquidity and fair value gaps. And that, guys, is all you need. With that being said, I will end the video here. I hope you did enjoy. And like I said earlier, please do subscribe if you are new and drop a like. It doesn't cost anything, but it helps boost the channel. And I really do thank you guys for helping me to reach more people and spread the message I'm trying to spread. So I appreciate any likes. If you have any feedback or any questions at all, please do drop a comment. Join my Telegram with the top link in my description, as I post a lot in there and on Twitter. And my private mentorship is closing really soon and probably within the next week. So check out that as well. It's a link in the description, or just join the Telegram and there's some information in there. With that being said, I'm not going to bore you anymore. Thank you as always for watching, and I hope you guys have a good one. See you in the next one.